Stop right there before you transfer that cash gift to your kids or grandkids, thinking it's a simple act of kindness. You could be setting them up for a hefty HMRC tax headache that lingers long after you're gone, especially with the latest twists from the 2025 autumn budget shaking things up. I'm talking real, up-to-date rules that every UK senior on benefits needs to grasp right now, because ignoring them isn't just risky, it's costly. Whether you're drawing from your state pension, pension credit, or other HMRC managed support, gifting money without the facts could slash your family's inheritance by up to 40%, and recent changes make smart planning more urgent than ever. But don't worry, I've got the insider breakdown as a tax expert, loaded with exemptions and strategies to gift tax-free today. Stick around, because what I'm sharing could shield thousands from unnecessary bills. And if this hits home, hit that like button to spread the word to more folks like you navigating these shifts. Let's cut to the chase. The core problem with gifting in the UK hasn't budged much post-budget, but thresholds are frozen solid until 2031, meaning more estates could tip over the edge as values rise. Your hard-earned savings or pension pot, HMRC's eyes are on them via inheritance tax, IHT. And if you're a benefits recipient, you might think your estate is modest, but add in a home or accumulated funds, and suddenly you're in the firing line. The biggie is still the 7-year rule. Any gift over the exemptions is a potentially exempt transfer, PET. Survive 7 years post-gift. It's tax-free, wiped from your estate, but pass away sooner, and it's clawed back, potentially hitting 40% tax if your total estate exceeds £325,000. The nil rate band that's stuck there, no inflation uplift until at least 2031. And here's the fresh sting. From April 2027, unused pension funds join your estate for IHT calculations. No more dodging that bullet if you're under 75 at death. If you're on benefits like pension credit, this could erode what you plan to pass on, turning a generous gesture into a tax trap. But taper relief offers some breathing room if you die within those 7 years, provided you've lasted at least 3. Die in years 0 to 3, full 40% whack. 3 to 4 years, drops to 32%. 4 to 5, 24%. 5 to 6, 16%. 6 to 7, just 8%. Still, with thresholds frozen, more families will feel this pinch. The good news? Exempt gifts are your secret weapon, unchanged and ready to deploy tax-free immediately. No 7-year wait. Start with the annual exemption, £3,000 per tax year. Gift it to anyone or split it. And if you skipped last year, carry forward for a £6,000 boost this time. As a benefits beneficiary, this is gold for steady, small transfers without dipping into capital that might affect your claims. Then, small gifts. £250 per person, per year, to as many as you want. Perfect for birthdays or helping out without triggering alarms. No overlap with the annual one, and it doesn't start that dreaded clock. Weddings? HMRC's generous here. £5,000 to your child, £2,500 to a grandchild or great-grandchild, £1,000 to others, pre-wedding or on the day, stacking with other exemptions. But the powerhouse for seniors like you is gifts out of normal expenditure if your income, say, state pension plus benefits, leaves surplus after bills. Regular gifts from that excess are unlimited and exempt instantly, as long as they don't cramp your lifestyle. Imagine £500 monthly to family, tax-free, with records to prove it's from income. For benefits folks, track this meticulously. HMRC might scrutinize if it impacts means testing, but done right, it's a game changer. One budget tweak to flag. Charitable gifts now only exempt for UK-registered charities or sports clubs. No more loopholes via unregistered trusts. If you're gifting to good causes, double check. And for expats or those with overseas ties, the new residency rules mean long-term UK residents, 10 of last 20 years, face IHT on global assets, but gifts of non-UK stuff pre-residency can escape. Bottom line, don't gift blindly. Document everything, dates, amounts, recipients, to arm your family against probes. Chat with them now, review annually, and grab pro advice if your setup's complex. Right, let's get straight into the heart of this because time is ticking. And with the rules evolving, especially that big pension shift coming in 2027, every UK senior needs to act smart now to protect what you've built. You're on benefits, drawing that state pension or pension credit, maybe topping up with a private pot, and you want to help your family without HMRC swooping in later. The truth is, gifting isn't as straightforward as just handing over cash. Get it wrong, and your loved ones could lose 40% to tax, even on modest amounts, because thresholds are frozen solid until 2030, dragging more estates into the net as house prices and savings creep up. Let's break down the 7-year rule properly, the one that trips up so many. Any gift larger than the exemptions is a potentially exempt transfer. Simple. If you survive 7 full years after giving it, poof, it's out of your estate forever. No inheritance tax. HMRC forgets it exists. Your family keeps every penny. But if you pass away inside those 7 years, that gift snaps back into your estate for tax calculations. And with the nil rate band stuck at £325,000 per person, £500,000 if you qualify for the residence nil rate band by leaving your home to direct descendants, or up to £1 million for couples transferring unused allowances. Anything over that gets hit at 40%. For folks on benefits, your estate might seem small, but add a home, some savings, and now that pension pot looming for inclusion from April 2027, and suddenly you're over the line. That's the real kicker coming soon. From the 6th of April 2027, most unused pension funds and death benefits get pulled into your estate for inheritance tax. Right now, pensions are a golden ticket. Pass them on tax-free outside the estate. But post-2027, if you're under 75 or over, those pots could face 40% tax, pushing more families into bills they never expected. If you've got a decent private pension alongside your state one, start thinking ahead. Maybe draw down wisely or gift strategically before then, but always check it doesn't affect your benefits claims. Back to easing the blow if things don't go to plan. Taper relief is your safety net inside those 7 years. No relief in the first 3 years. Full 40% if taxable. But survive 3 to 4 years? Tax drops to 32%. 4 to 5, 24%. 5 to 6, 16%. 6 to 7, just 8%. It's a gradual slide that can slash thousands off the bill, giving your family breathing room. I've seen it save estates tens of thousands. Imagine gifting £50,000 for a deposit, dying 5 years later. Without taper, potentially £20,000 tax if over threshold, but with it, down to £8,000. Still not zero, but better than nothing. The key, pen assuming you might not hit 7 years, because none of us have a crystal ball. Now, the exciting part, the gifts you can make today that are completely exempt, no 7-year wait, no tax ever, perfect for seniors wanting immediate help without worry. First up, your annual exemption, £3,000 per tax year, straight out tax-free to anyone, split however. Skip a year? Carry it forward once for £6,000 this April. On benefits, this is ideal, small, steady transfers from income without touching capital that could mess with means testing. Stack on small gifts. £250 per person, per year, to unlimited people. Grandkids' birthdays, a niece's treat, each £250 is exempt, separate from your £3,000, no clock starts. Over a decade with 10 grandkids. That's £25,000 gone tax-free, easy. Weddings shine here too, generous allowances. £5,000 to your child, £2,500 to grandchild or great-grandchild, £1,000 to anyone else. Give before or on the day. Stacks with others accept small gifts. Helping with a wedding? Do it right. Zero tax. But the real powerhouse, especially for pensioners with steady income, is gifts out of normal expenditure. This one's unlimited, no cap. If your state pension, private pension, or benefits leave surplus after essentials, regular gifts from that excess are exempt immediately. Say your income covers life comfortably with £500 left monthly. Set up standing orders to kids or grandkids. That's £6,000 a year tax-free, forever. Over 10 years. £60,000 plus. No 7-year rule, no tax. For benefits recipients, prove it's true surplus. Don't dip into savings. HMRC loves patterns. Monthly or annual, same amounts. Proof is everything here. Bank statements, income records, expenditure logs. Maybe a letter explaining intent. If challenged after you're gone, solid records win. I've helped families defend 6-figure gifts this way. HMRC backs off with evidence. Common pitfalls. Don't call a gift a loan without proper setup. Formal agreement, interest, repayments, Or HMRC treats it as gift anyway. Helping buy a house. Straight cash gift starts the clock. Joint ownership can trigger capital gains later, worse mess. And married couples? Massive edge, spousal transfers tax-free. Unused thresholds double up to £1 million potentially. Not married. No exemption. Full tax risk. Some tie the knot late for savings alone.